What kind of picks right now you have in your European corporate bond portfolio?
We still like the investment-grade corporate bond space and the double Bs. I think it's still attractive. The market is benign. So from that perspective, we like the subordinated debt space still, both on the corporate hybrid side and the financial segments, both insurance companies and banks. So, you know, our expectations is that government yields are going to stay low for a bit longer, perhaps another few years at least, while the deleveraging process, you know, continues to evolve. So from that perspective, credit still is a good space to be in because you can earn a spread premium and it's all about carry.
Why specifically you're still interested in subordinated bank debt?
There's still value there because I think as a whole, the bank space and the financial institutions are continuing with their deleveraging. So capitalization is improving. And, you know, the subordinated bonds continue to have value. They trade the older style, for example, lower tier 2s trade at about 200 basis points in terms of mid-swap spread, so that's still quite attractive. But also you have the new style subordinated bank deals which are now arriving to the market, the COCOs and the additional tier 1s and tier 2. And we think these are attractive despite the supply level that we expect, simply because it's a new asset class and it tends to pay a little bit more. You can easily buy some tier 1s with coupons of about 5.5% to 6%. So at this stage, they are attractive, especially that the regulation surrounding the additional tier 1s is not completely finalized. The important dates is going to be 2016, when, for instance, the additional buffers are going to be decided upon. But until then, you know, this is a space that should remain attractive.
Do you foresee a new round of ECB intervention? Do you think this is going to affect significantly the European corporate bond space?
Yes, I think one of the drivers that led us to think that there is still value in corporates is the fact that the ECB might end up doing something. It is evident that in Europe we're experiencing some strong disinflation pressures, and the ECB will be quite keen to try to counter those. I think the ECB could start lowering rates from next month. What's important is that they will probably lower the bank deposit rate, and if they lower the bank deposit rate, basically the banks will have less of an incentive to deposit money with the ECB, so they'll probably keep their cash. And since lending growth is very slow or even negative in Europe, I think the financial institutions or the banks will be inclined to buy more bonds in the markets, so that will create a bit of a crowding out effect, and you know, it snowballs, and then the demand for corporates will be going up.